Hello everyone, welcome back to Market Update featuring by Marketsall and Recession. I'm Roy Güllüoğlu here. As usual, in this week's video, we will be evaluating what's the latest market developments. We received Nonfarm Payroll numbers last Thursday actually, and it came like much better than expected. And like S&P 500 hit its all-time high, then Bitcoin hit its record high. There was a huge volatility in a good way. Let's first dig into how did the data flow evolve in that way, starting from the last day of our video, which is our last video was in Wednesday. So after Wednesday, what happened? Let's go briefly through the economic calendar. First of all, as you can see here, on Wednesday last week, we received ADP employment report. So for the first time since March 2023, the ADP private payrolls report showed a net job loss. Actually, job losses were seen in education and health, financial services and professional businesses. And when you compare the large firms and a small and mid-sized ones, large firms the firms with higher employees added 30k jobs, while small and mid-sized businesses were losing ones. And ADP's the report, the publishing site, ADP's chief economist, they noticed the layoffs remain rare, and companies are increasingly hesitant to backfill departures. That means they're not seeking to replace someone, or they're not necessarily looking for a replacement, or they're not necessarily looking for a new hire. That means that's actually easing the pressure of wage growth, which is a good sign in terms of the disinflationary path. Wage growth, briefly, it's a moderate. The wage growth continues to be moderate for both job switchers and job stayers. As you might recall, that Fed's Jerome Powell was also in the same page. He was also mentioning this, that they were still waiting for this development to happen. It's in terms of inflation, it's good sign, but when you look at the ADP itself, you see that the actual number came minus 33k. The forecast was 99k, so that was a bit. So before switching to other data, I just want to remind you how to evaluate those numbers. First of all, if you receive any bad data coming from labor side or economic growth side, that means the rate cuts might be faster than expected in order to protect the labor markets, right? That's the mentality. And with that mentality, the expectation is with lower rates, risky assets will gain much more momentum. That's debatable. I'll come to that in this video in the later part, but there are some more other details about that, but that's the main mentality. So if we receive a bad ADP employment rate data, at that moment we might see that, for example, sell-off in crypto, sell-off in equities futures, equity index futures, or risk-on currencies like Australian dollar, New Zealand dollar, we might see that kind of implications. Why I'm saying this? After this, whenever you're just closely watching data, you just need to consider these you just need to think about in this way in order to evaluate that current market movement. Apart from that, we received last Wednesday the service PMI from China, and it's a higher than 50. That means it is still on the expansionary phase, which is also a good sign in terms of a global economic growth. On Thursday, since the 4th of July was a holiday in US, the non-farm payroll number was announced on last Thursday instead of last Friday. So first of all, headline payroll came in a stronger 147k versus 111k forecast, and previous number, as you can see, 144, which is also revised from 139, as you can see here. That revision is important in order to say that if we see some trend that keep up revision, that means maybe we should be careful on the main trend of labor market situation. But the prior 2 months also were revised up by net 16K. It's another indicator that is highly influential. Unemployment rate ticked down to 4.1% from 4.117%. When you look at a household survey, there's that showed that the non-farm payrolls coming. There's two different surveys are done when one is the source of the unemployment number, one is source of the non-farm payroll number. So the household survey showed 93K in employment, which is consistent with unemployment rate is steady. So it's totally opposite, suggesting a totally opposite outcome than the ADP number, which was surprising for the market, as President Trump was doing a lot of putting a lot of pressure on Jay Powell lately to push him to resign, as he is not cutting rates. In such an environment, the expectation was the economy is so bad, that's why he's pushing like that. But when you go into details, you can see also that the governmental side, the hiring is too much around there. The resignation of Elon Musk from Doge might be also another result of this. I don't know, but yeah, during also the rate hike times, when we were seeing a high a non-farm payroll number, when you dig into that data, you would see that the government side was hiring much more than the private sector. So government was supporting a lot, and now we're seeing that as well. When you look at in details to data, the government jobs, as I mentioned, surged a lot. Construction added a 15K jobs. Manufacturing lost 7K jobs, and trade and transportation reversed previous losses with a modest gain. And when you look at the average hourly earnings data, which is important in terms of the inflation side. So when you look at this data, average hourly earnings, both year over year and month over month, are important in terms of inflation. But non-farm payroll, private non-farm, unemployment rate, both these three data is important in terms of labor growth. So as they are a positive, we can say that the labor market is solid. When you switch to the average hourly earnings rate, we need to evaluate with the mindset of inflation. So as you can see, average hourly earnings rate increased 0.2% in monthly, which is really good sign in terms of a disinflationary path. That means that inflation is still easing. As you might recall that the good side of the inflation had shown some strength lately, because that was the part that already the disinflation was gained. But to see such a movement that there was a bit risky for the sake of the rate cut path. But yeah, this is hopeful data in terms of that. I think it's 15th of July we're going to receive US CPI number. That will be pretty crucial data, as we saw some spike in goods inflation. We need to watch it carefully. So what are the market implications? We need to look in from the asset perspective. Risky asset responded for sure positively. The S&P 500 advanced first since the tariff deal, at least a temporary deal, gained. The S&P 500 advanced, led by mainly AI linked names, financials, mainly, also communication side become big, Magnificent Seven also was have been the biggest contributor, apart from Tesla, as it was so volatile, but lately it's showing some strength. Gold saw some profit taking activity at first, but then immediately it gained its strength backed. I'll show the charts of all these, but the DXY still downtrend continues. Silver is also going really like a strong, as it's acting as like a precious metal plus, because it's benefiting from when the rate cuts, when the like first in general, like the trend is currently this like geopolitical risks were there. That's why silver was also attending there, plus silver was trying to catch up the gold. That's the main mentality of its appreciation. After the data, we saw that treasury yields moved up slightly. I personally expect like the September rate cut on the table, but with this data, it's like, okay, there's no need to cut that fast. There's that mentality. I don't agree with this mentality, but as I'm thinking that there should be sooner rate cuts, I expect treasury yields to come faster than it is seen. Crypto remains still strong, especially like Bitcoin. And yeah, like just to summarize it, we can say that the data lowered the recession risks and support the base scenario, which is the soft landing scenario. It's a scenario with low inflation plus low unemployment rate, like a solid labor market. And yeah, that's the general picture. And we started to see some new all-time highs in asset prices. So let me switch to this chart. I want to show you a scenario analysis here that I highly give importance here. So here on the left hand side, it's the asset. And so, okay, now we're currently seeing what solid labor data brings to market. But what if the labor market starts to disrupt, starts to crack? Will stocks go up because the Fed might cut rates, or down because we're headed into the recession? That's the main question, I think. And it doesn't have a simple answer, unfortunately. Recently, we have seen a sign of a weakness in the economy just before this non-farm payroll data, and ADP was one of that weak data, especially in the labor market. So in such an environment, we would expect to see a faster rate cuts. That's for sure bullish for risky assets. That's the main mentality, but it shouldn't be that fast actually. The reason for those rate cuts matters, but if the Fed is cutting rates because inflation is under control, that's one thing. But if they are cutting because the labor market is breaking, that's a whole different story. A sharp disruption in the labor market does not unlock rate cuts. It also raises recession risks. That means a falling earnings. And as we are just getting into the Q2 earnings, and according to FactSet data, major banks are lowering their Q2 earnings expectation. With that in mind, that means a falling earnings, slowing consumer demand, and a possibly rising defaults in such an environment. So while the headline might say rate cuts coming, the underlying signal might be economic trouble ahead in such scenario, which is not the case right now. We're just doing a scenario analysis here. And we need to evaluate the strength of that disruption in the labor market. Okay, that's the key sentence, I guess. Is it or maybe it's not that important. That's why if we need to closely watch some indicators. So here, for example, in this table, I try to show you how would assets will react in such movement. For example, if labor weakness, there's just with soft landing scenario, we would see a relief rally in especially tech and growth stocks. But in a recession scenario, a broad sell-off in rotation to defensive inequities. And bonds, for example, in this soft landing scenario, long duration rallies, which is long end of yield curve, will come down. And vice versa here. USD, as in the current scenario, we see weakness in USD. We would expect to see the continuation of that. On the other end, we could see some strength in USD, as it will behave as a safe haven. And gold, I think it's the only asset that would be benefit from both sides, because if there's a soft landing scenario, rates gonna come down and real rates gonna come down. And when the real rates are coming down, we will see some appreciation in gold prices. That's what you expect. But on the other hand, if the recession scenario comes in, then as a safe haven, gold might appreciate as well. So commodities also weak demand caps upside, and more defensive vice versa. Crypto, with the rate cut expectation, we might see short-term rally, but in a mid to long term, with the volatility coming, it might be just outflow from risky assets, and for sure cryptos are the most risky ones around the market. So bottom line, what I'm trying to say is, don't just react to rate cut headlines. Ask like why the Fed is cutting. Is it like because of the inflation side, because of the labor side? Yeah, not all rate cuts are bullish, just bear in your mind. So let me know, by the way, in the comments how you're thinking about this setup. I really would like to hear your thoughts on that. So July 9th marks like a crucial deadline for US trade deficits. The administration's like a temporary tariff pause expires at that date, and without like a last minute deal, several countries face steep tariff hikes, some up to like a 70%. We'll see if this triggers volatility again in the markets, as global trade tensions could spike, impacting like a supply chains, investors' sentiment worldwide. Apart from that, Q2 earnings season kicks in the inflation number on the next week, 15th of July, will be another hot topic in the next week. So quickly, I want to show you the reaction of assets to after the non-farm payroll number. So this is a US 10-year yield chart. I was mentioning this, let's say like a parallel channel, as a kind of consolidation in 10-year yields. When the price was going here, I was telling that I'm just watching this. If I had seen any breakout from this activity, then I would be more cautious on more like a higher for longer scenario would be kicked in. But that was not the case, and now it turned down. We saw a reaction after the non-farm payroll number, but we'll see how it continues. And DXY, classical, this chart, again, I'm following here. We didn't see any kind of rejection from here. And if that's the case, I think the next level would be around like a 95 levels, 94, 95 levels. Then we'll be watching 95 levels. Quickly, S&P 500, as you can see, another record is there. Here, if you're following me on X platform, I had shared this chart. Since the 2008 financial crisis, how did the S&P 500 reacted? And as you can see, now we're at the phase that after tariffs imposed, we're at the phase that tariffs delayed, ceasefire between Iran and Israel. Q1 AI investment was solid, plus earnings expectation is still good. But if we see a disruption in tariff plus geopolitical events, or we might see some like a breaking in the Q2 earnings that we're getting into, then we might see some profit-taking activity. But still, there is nothing like a solid evidence to support this idea. Nasdaq is another in the indices that is going to its all-time high. And as you can see, technically, this like a cup with handle seems pretty nice. I mean, generally, when you look at like the weekly, it's not that nice, but generally, I really don't like to see V shape in cup with handle, to be honest. But when you look after this tariff issue, when you look at all charts, it's like that. And generally, a proper cup with handle I expect to see 7 to 60 week cup and handle base to occur. And while the handle side is occurring, I would like to see lower volume, at least like lower than the average volume, this yellow line here. And as you can see in this 2-week red candles, you can see that volume comes down. Then this breakout comes with higher volume, which is positive. We might see some pullback activity around to like 22k, 22,140 levels. Yeah, that's pretty normal to see such thing. NVIDIA, I just wanted to show this as well, as like the leader of the recent rally that we have been experiencing after the COVID phase, after the rate hikes and stuff. And as you can see here, there's a cup and handle is not formed yet, but I would expect to see some pullback and like profit taking activity with the low volume coming down. And maybe this earnings might be a catalyst to see a breakout again if everything goes smooth. Another chart, Tesla. So in the Rationale newsletter service, I had shared this head and shoulder continuation chart pattern as a like trade idea, and it moved amazingly well up until here. It couldn't touch to the head and shoulder bottom chart pattern price target, but those targets are just indicative targets for those. I mean, it's just only relevant to this pattern only, you know. So what I'm trying to say is, don't rely on these targets that much. They're just like indicative, also like breakout failure level as well. I'm just trying to offer like here to give you some trade ideas, and just get those trade ideas and adapt those into your trading strategy. Maybe you're just like a long-term investor, then you come to this weekly chart and you can just spot this area as a good adding strategy, you know. And you might be a swing trader just getting into here in this equity with a stop around here, for example, or stop around here by aiming to get your profit around here, you know. It depends on your mentality. And currently it pulled back, and with all these tariff issues and stuff, now we're seeing when you go to the daily chart, there was a rectangle chart pattern here, and it's like a broken out, pulled back. As you just check where it got rejected, tried to resume again, same rejection from the same level, and now it's trying to turn. But I couldn't be confidently bullish on here, as there's like a too much volatility. But for sure, like a robotaxi, like all robotic AI investments coming from Tesla, plus I think President Trump, this like green energy law legislation issue, I mean, all are supportive to Tesla. Also Elon Musk, if he concentrates back to its company again, we might see some appreciation. Meta here again, I just wanted to show you this, as I'm waiting to see some pullback activity, which would lead to form a cup with handle as well. That's why, just like if you can put an alert around here to wait such activity, and like I just wanted to share to you that you can put into your watch list. So in general, that's all I want to talk about this week. I hope like you find it useful, whatever you see here. And if you have any question, just like please like write as a comment. I would be glad to answer. And I wish you a really like a nice week. And please don't forget to like our video, and please don't forget to subscribe to Marketsall YouTube channel. Also, you can subscribe to Rationale newsletter service from the link below the video. Have a good one. Bye.